Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 391 on September the 5th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on the AdvisorShares Trust, Pure U.S. Cannabis ETF, Alt5 Sigma Corporation, and First Majestic Silver. And we discussed three new trades on aTyr, Pharma Inc., American Airlines, and Hewlett Packard. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on the show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. As a heads up, in case you haven't already figured it out, my voice is completely shot. I dealt with some allergies, seasonal allergies this past week. It's left me without a voice, but even though my voice is a little weak for the show, don't worry. The information and the trades are going to be just on point like normal. So thanks for hanging in there with me this show, and I'm sure my voice will be fine by next week. Now, the market's had a lot of daily movement, but managed to finish the week relatively unchanged versus last week's closing prices. The Dow Jones Industrial Average lost 144 points, ending the week at 45,400 points. The S&P 500 index gained 21 points, closing at 6,481 points on Friday. And now it's time for the topic of the week. The topic of the week is quick math. I have dozens of stories from my time on the trading floor. I even have some good ones from the interview process before I got the opportunity to even trade on the floor. Now, I had a guy ask me, what is 16 times 25? I took a moment to give him the correct answer. Apparently, I was a few seconds too long, because when I finally gave my answer, 400, he said, what took you so long? I told him that I took 6 times 25, which is 150, and added it to 10 times 25, which is 250. He said that takes too long. How many times does 25 go into 100? I told him 4. How many times does 4 go into 16? I said 4. He said, why didn't you just multiply 4 times 100? You would have gotten the answer in half the time. That was my first taste of the math required on the trading floor. It was never complicated. It was simple math done over and over again. People often ask me, how do I find the trades that I look for on this podcast and on a daily basis? The answer still comes down to quick math. I constantly am looking for spreads that fit my strategy. I do the math quickly to see if I should take the trade or not. It either fits or it doesn't. There aren't a whole lot of decisions to make beyond that, other than the direction of the stock. Now, I know if the math works, then over time, I'll make money. I use the assumption that all the additional information I need affecting that trade is priced into the spread right at that moment. So I do the math and decide whether or not to take the trade. Of course, it has to be in the direction that I'm looking to trade. So over time, I win. Now, there's great information being provided with spread pricing, but we can get into that another day. Just know that this game comes down to doing the math and understanding the risk behind the math. Simple math can make big money. I still do quick math in my head to pay homage to the guys who brought me into this game more than 2 decades ago. So that's it for the topic of the week. Let's go ahead and get into the review of last week's trades. Now, we're going to start off with our covered call on the AdvisorShares Trust Pure U.S. Cannabis ETF, symbol M as in Mike, S as in Sierra, O as in Oscar, S as in Sierra. At the time, the stock was trading for $5.55 per share. I looked at buying stock and selling the September 6 call at 67 cents, hoping for a return of 20.18% in 3 weeks. Well, shares of MSOS lost 78 cents, ending the week at $4.77 per share. The call option we sold lost 38 cents, leaving us with a net loss of 40 cents if we were to close the trade out immediately. Now, we are 11 cents below our break-even point, and we have 2 weeks left until expiration. So if we're going to make an adjustment, now's a good time. Now, we could collect 43 cents If we buy back the 6 strike and sell the 5 strike, that rolls the strike on down. That immediately removes our week-over-week loss on the trade. However, it also means that a short price correction could lead to us being assigned on the call and losing the stock that we have in this trade. So if I take that into account and the fact that the stock is only 11 cents below the break-even point, and right now I can sell the October 6th strike at 55 cents, suddenly this trade doesn't look bad at all. It's still a loss on the week, but I'm still hopeful that the stock could pull higher or at least not free fall over the next 2 weeks. I'm leaning towards letting that option expire out of the money in 2 weeks and then looking to sell another option at or near the money option with the October expiration date in mind. Next up, we have a credit spread on Alt5 Sigma Corporation, symbol A as in Alpha, L as in Lima, T as in Tango, S as in Sierra. At the time, the stock was trading for $7.87 per share. I looked at selling the September 7-6 put spread at 40 cents. That can give us a maximum possible loss of 60 cents per spread. Shares of Alt5 Sigma fell $3.47, ending the week at $4.40 per share. And let me just start off by saying this is why I prefer using spread prices rather than stock on a lot of these riskier trades. Now, the out-of-the-money put spread that we sold is now deep in the money. To close the trade out would cost us the full loss of the spread, full $1, so there's really no reason to do that before expiration. Now, there's always the chance that the price could come back over the next 2 weeks as well. I would still be a fan of selling a call spread against this trade to create an iron condor. However, the higher strike call spreads aren't pricing higher than 5 cents each. That's not worth it at this point. So if we take a full risk loss on closing the trade early, then I would stay in this one to see what happens over the next 2 weeks. The market might pull back some, allowing us to regain our original economics. I would only close early if we were going to save a significant amount of our risk on the trade. At this point, might as well go for the ride. Now, as always, I am discussing my position and how I view the risk. Everyone has to make the best decision for themselves and their own risk tolerance levels. Our final trade from last week was a debit spread on First Majestic Silver Inc., symbol A as in Alpha, G as in Golf. At the time, the stock was trading for $9.14 per share. I looked at buying the September 8/2/9 call spread for 33 cents. That could give us a maximum gain of 17 cents or that's 51.52% return on capital in 3 weeks. Well, shares of First Majestic Silver lost 1 penny, ending the week at $9.15 per share. The in-the-money call spread that we bought is still in the money, and the economics of the spread have held up over the last week. If the stock expires above $9 per share in 2 weeks, then we collect the full reward of 17 cents on this trade. So far, this trade is working out. It's the only one that worked out from last week as planned. Fingers are crossed for the next 2 weeks for sure. So that's it for the review of last week's trades. This is the last week that we will use the September 19th expiration for new trades. All new trades on today's show are higher risk because there's only 2 weeks left before expiration. That means there'll be less time to make any adjustments if needed or desired. So always remember that I share trades I'm looking at that fit my risk profile. We all have different account sizes, experience levels, and risk profiles. So just keep that in mind. All right, we're going to start off with a covered call. You'll definitely want to keep that idea in mind on this one. This has been a pretty high news stock. So looking at a covered call on aTyr Pharma Inc., symbol A as in Alpha, T as in Tango, Y as in Yankee, R as in Romeo. Stock ended the week at $5.61 per share. I'm looking at buying stock and selling the September 6th call at $2.40, hoping for a return of 49.73% in 2 weeks. Just know that when you see the math and it adds up to nearly 50% return on capital in 2 weeks, this is a high-risk trade. So just putting that out there. Now you enter this trade by buying stock for $5.61 per share and selling the September 6th call at $2.40. This trade makes the most money if stock prices finish above $6 per share. The break-even price is $3.21 per share. In real terms, the stock purchase will require $561 and you'll collect $240 for selling the option. Next up, we have the credit spread on American Airlines. Symbol A as in Alpha, A as in Alpha, L as in Lima. Stock ended the week at $13.09 per share. I'm looking at selling the September 13 12-half put spread at 17 cents. That can give us a maximum possible loss of 33 cents per spread. Now you enter this trade by selling the September 13 put at 47 cents and concurrently buying the September 12-half put for 30 cents. This is the credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $13 per share. The break-even price on this trade is $12.83 per share. In real terms, you'll receive $17 per spread that you sell and have $33 at risk. Our final trade on the week is going to be a debit spread on Hewlett Packard, symbol H as in hotel, P as in Papa, E as in Echo. Stock ended the week at $23.53 per share. I'm looking at buying the September 23 half call spread for 32 cents and give us a maximum gain of 18 cents, or that's a 56.25% return in 2 weeks. Now you enter this trade by buying the September 23 call for 84 cents and selling the September 23 half call at 52 cents. This is a debit spread because we are buying the spread. This trade makes the most money if stock prices expire above $23.50 per share. The break-even price on this trade is $23.32 per share. In real terms, you'll pay $32 to enter the spread, and your maximum gain is $18 per spread. And let me make one clarification here. So oftentimes, I'll find debit spreads like the one I just mentioned that have the possibility of a 56%, like a greater than 50% return in 2 weeks. And that's great. We can do that all day long. If you've listened to the show, you'll know that I've done those trades, and you'll see the number of times that I've made. Occasionally I'll lose, but do make money on those trades too. This trade though, the debit spread, you're only going to risk $32, right? That's different than the covered call that I mentioned where you're making 50% on a $561 cash outlay. In fact, without the stock moving at all, you're making $240 on $561 of risk. That's crazy, right? That's crazy. That's why I love the math. And these trades pop up. Now, this stock could blow $5 or it could crash. Either way, whatever happens, as long as the stock doesn't go under, right? As long as it doesn't fully just disappear and the company blows up, then I would keep trading this and keep selling calls against the stock until I make money and get taken out of my stock. Or, you can look at that wheel method. Some of you are familiar with the wheel method too. And, the wheel method's not a bad way to go on some of these high volatility, high risk stocks as well. So that's it. That's going to be it for the show. I just wanted to make that difference since I pointed out the 50% in 2 weeks on the covered call, but I didn't make a big deal of it at all on the debit spread. Making a 50% return on $32 is different than a 50% return on $560. So anyway, hope you guys have a wonderful weekend. I'm going to stop talking so I can rest my voice. Look forward to having you guys on the show again next week. Take care, and as always, happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.